Good morning, everybody. My name is Sarah Krom. I'm managing partner of SKC and Co CPAs, and welcome to today's edition of Office Hours. We took off the month of September for a little hiatus, but we are back with a super important topic today, which we will get into after just a few housekeeping issues. If you've joined us before, just so you know, we do record this session. We make it available to all participants, as well as on our website for anybody who wasn't able to make today's session. So just be aware of that. In addition, we do several surveys throughout the presentation just to make sure you guys are still with us and to kind of get a pulse of who our audience is. So they will pop up at random points throughout the presentation. If you could participate, that would be really great. And then finally, this is interactive and here for you. So we really do want you to ask any questions that you have, and you can do that via chat. Our marketing director, Karen Donaway, is our backup today, and she will sort of be monitoring the chat and interjecting when appropriate. The one thing I do want to say about the questions today, because there is such specificity in everybody's individual Social Security situation, marital situation, age, etc. If it is a very specific question to your situation, we are going to ask that you utilize Ash's offering that will come up later for a free 15-minute consultation, and we'll provide information on that at the end of the program. So I just want to make sure we do touch on everything that we want to get through today, and Ash has been gracious enough to offer that free 15-minute consultation for anyone today. So without further ado, Ash, thank you so much for being here today. This is probably the first topic I think we've done that touches every single person, not just business owners, not just people who have children, not just people who are entrepreneurs. So this really impacts everybody across the board. We're so grateful to have you here today. I'm going to turn it over to you briefly for a quick introduction and telling us a little bit about yourself. So welcome, Ash.
All right. Thank you, Sarah. And thank you all for attending today's webinar. So by way of background, I grew up in Canada, which is great. Now I'm teaching Social Security around the United States, but I'm a recovering accountant. I was a CPA with KPMG in Canada. I then went on to the Wharton School of Business for my MBA. In the past 30 years, I've been doing financial planning. I'm a certified financial planner, but my focus is retirement planning. And I realized you really have to do a deep dive on Social Security in order to do retirement planning properly. And I just couldn't find any experts. So I just decided I'll become an expert. So I ended up getting 2 certifications in it, invested in sophisticated software. I've done over 2,000 customized plans. In 2016, I won an award as the National Social Security Advisor of the Year, the top Social Security advisor in the country, which was wonderful because it got me into the Wall Street Journal and Barron's and CNBC and TV and radio. So it's a top, as you mentioned, it's a subject that really touches pretty much everybody in the country. It's a federal program. And so the interest in the topic continues to grow because very few people have pensions anymore. They have IRAs and 401ks, but they all have pensions. They have Social Security. And you have to make a filing decision. You want to get it right. So that's really been a great addition to our firm. We have a team of specialists here at One Team Financial, Medicare specialists, retirement planning specialists, estate planning, et cetera. So Social Security is its own silo and deserves special attention.
And we are here to give it that today, Ash. So thank you again for being here. I'm going to start off with some statistics to share with the audience, things that sort of fascinated me when we were preparing for this, that there are over 2,700 different rules pertaining to Social Security and 567 filing options that you can consider. So it's not surprising then, Ash, that over 90% of filers get less money than they really are eligible for, right? And
Correct.
We're here today to make sure that those on the call are not part of that 90%. So we are going to start with, I think it's a cute little survey question. I know it's one that comes up at cocktail parties a lot. Brittany, if you could go ahead and throw the first survey question up. Do you think Social Security will be available when you retire? Obviously, it's NA if you are currently collecting, because you know that answer already, but just curious to see where people sit on this topic. And Ash says it's one of the common questions he gets as well. Great. So Brittany, if you want to go ahead and share those results. And Ash, what are your thoughts on that? Did you expect that much of a spread in the yes direction?
Well, maybe they're hopeful. No, I'm kidding.
It is a Friday. People tend to be in better moods.
Well, here's what scares people. They get the headlines that the Social Security Trust Fund is going to run out of money. And in fact, Before COVID, they estimated they would run out of money in 2035. Now they're saying as early as 2031. So 10 years from now, if the trust fund goes to zero, what happens to your check? Most people think they get nothing, but if they make no changes, you'll still get about 80% of your projected benefit. But I'm confident they will continue to make changes because it's just too important a program. Because as I said, most people don't have pensions, they have Social Security. And you can't run for president, go to Florida and tell people you're going to cut their Social Security. It doesn't work. So will there be changes? Absolutely. It's such an expensive program to fund, but they can do things like push the full retirement age out. So if you're a younger person, 20, 30, 40, you may not get your check at 67. Your full benefit may get pushed out to 70. That's an easy fix. Young people don't think they're getting anything anyway, so that's okay. But you know what? They could cap the cost of living, eliminate it. They could increase the taxation of Social Security. You only pay the Social Security tax up to the wage base 142, 800. But Medicare, you pay tax on all your income. So why wouldn't they raise that wage base? So there's a lot of levers they can pull. They're going to do it. People are just too dependent on Social Security. So I would never race into Social Security to take it early because you think it's going to run out of money. There are other reasons you may want to take it early, but not that.
So then at 38, I should feel fairly confident that it's going to be there. I may not be able to collect till I'm 87, but there will be something.
Yeah, your full retirement age will be 102.
Hey, so shed a little light, if you could, Ash, on how Social Security is calculated.
Okay, what they look at is your highest 35 years of indexed earnings. Okay, so not consecutive years, just your highest 35. So maybe you don't have 35 years of earnings. You have 20 years. Maybe you were a stay-at-home mom for a few years. But when they do your calculation, they'll take, say, those 20 years of earnings plus 15 zeros. Okay, so your benefit will get dampened down. So anytime you can replace a zero with a year of earnings, that will count. In fact, even if you're collecting Social Security, if you're still working, those earnings years will be used to recalculate your benefit. But what's also important is how you get it to qualify for benefit at all. You need 10 years of earnings, specifically 40 quarters. Again, not consecutive. But if you earn $1,470 in a quarter and you have 40 quarters, 10 years, you'll qualify for a basic benefit, which could be worth as much as $500,000. Most couples don't realize, but over their joint retirement years, they'll get about $1.5 million from Social Security. I have clients who will get over $2 million. Some of my clients are collecting almost $100,000 a year from Social Security. It is a rich pension, but unfortunately, most people have never really looked at it.
Wow, interesting. Great. So I do want to talk about what's considered full retirement age. And for those of you that have been on office hours before, we don't normally have PowerPoints, but we do for a few of the topics today because it is so important that you can visualize some of this. So Ash, I hope that everyone can see the PowerPoint and let's jump into what is considered full retirement age for some folks.
Okay. So when you get your statement, or if you go online and print one out, they will tell you what your benefit is at your, quote, full retirement age. So if you were born between 1943 and 54, it's 66, 1960 and later, it's 67, and in between, it's 2 months per year. But the importance of that is, once you reach your full retirement age, you can file for Social Security regardless of what your earned income is. If you file between 62 and your full retirement age, if you make more than $18,960, every $2 above that, they'll take back $1 of Social Security. So for most people, filing early is really not an option if they're still working. But once you get to full retirement age, you can continue to work, make as much as you want. They won't withhold any benefits. But by the way, Social Security makes nothing simple. When I say there's 2,700 rules, I think there's like 6 rules and 2,700 exceptions. So for example, look at the chart, look at the year you were born and ask yourself, is it possible to have more than one full retirement age? Well, no one was born twice, right? But you could. And here's the scenario. I just had this. My client, she's a widow. She's 65. She was born in 1956. So her full retirement age is 66 and 4 months. She's eligible to collect $3,000 a month as a survivor benefit, but because she's still working, she can't collect until she gets to full retirement age. But guess what? There's a different full retirement age for survivor benefits. For someone born in 1956, it's age 66. So if she waits to 66 in 4 months, she will have missed $12,000 in survivor benefits, $3,000 a year for 4 years. And Social Security is not going to contact her and say, by the way, you're 66 now, you're eligible to get your check. And if you miss it, you can't get it back. So again, people just don't know what they don't know. They leave thousands of dollars of benefits on the table because the way Social Security works is if you don't ask for it, you don't get it. So it's your job to know the rules.
That's right. And I remember, Ash, at one presentation that I sat in that you had done, everybody always seems to ask the question, when do I collect? Because there's always that cost benefit of the reduction that you get if you collect earlier. So let's kind of talk a little bit about that and how actually is Social Security calculated? What does it look like if you apply early? What does it look like if you, wait and max out on those benefits? And I know you have a slide for this too.
Yeah, terrific. Okay. So as I mentioned, you can file for a retirement benefit as early as age 62. And by the way, survivor benefits as early as age 60, unless you're disabled, then age 50. But anyway, for survivor benefits, if you chose to file at 62, you would get a 25% permanent reduction in your benefit amount if your full retirement age is 66. If it's 67, it's a 30% permanent reduction. At 63, it's a 20% reduction. So yes, you can file early, but you permanently reduced your check amount. Alternatively, if you go to the next slide, if you delay the start of your Social Security, I guess that's slide 11, maybe.
That one?
Yeah, perfect. Okay. If you delay the start of your Social Security, they guarantee to increase your check amount 8% a year. So your check amount at age 70 is guaranteed to be 32% higher than at 66. And by the way, that doesn't even account for the cost of living increases as well. But straight up, you get an 8% per year delay. Now, where are you getting 8% guaranteed on your money? Nowhere. So should everybody delay to 70 and maximize the check amount? Not necessarily, because the question is, how long does it take for that higher check at 70 to recoup the 4 years of checks that you just missed? And that's your break-even point, which is usually around 78 to 81. But again, you always have to look at Social Security as a couple. If you're, and when I say a couple, I mean a married couple, a divorced couple, widows, widowers. You always look at lifetime joint benefits to determine what the optimal filing strategy should be. So again, yes, even if you get to your full retirement age, there's an opportunity to increase your check amount.
Right. And I do want to let the audience know that in Karen's follow-up email that she sends out to all the audience members today, we will include these slides. So you will be able to reference back to them if you're on your phone or want to share them into the future with anybody. We will provide those for you. So Ash, any new rules on Social Security? I mean, there are just so many, and I like what you said that there's 6 rules and 2,700 exceptions, but anything new that maybe we haven't heard of that we should really be aware of?
Yeah, absolutely. Some of the attendees may have heard of filing and suspending. That was a big deal years ago, but in 2016, they eliminated it. It allowed you to collect the benefit off your spouse while you were delaying your own benefit. But that's off the table. But the biggest impact was on spousal benefits. Now, people don't realize there's actually 2 different kinds of Social Security spousal benefits. One that allows you to collect a benefit off of your spouse, 50% of their benefit while you defer your own. And the other says your own benefit, if it's less than half of your spouse's, you get the higher of the 2, your own or half of your spouse's. So the one that allows you to collect off your spouse while you delay your own, that's being phased out. You had to be 62 as of January 1st, 2016 to qualify for that benefit. But the other spousal benefit, they did not change. So I believe you might have a slide on that as well.
I do. Let's see.
Okay. But again, it's important to know that
Is that the right one?
Eligible. Yeah, perfect.
Great.
So here's an example of that other spousal benefit that exists. So let's say John and Jane are, their PIA means primary insurance amount, their benefit at their full retirement age. So let's say they both are 66, they both file. John's benefit's 2,000 and Jane's is 800. What's Jane eligible to collect? Well, she's eligible to collect the higher of her own, 800, or half of John's, which is 1,000. So she's going to get the 1,000. So why do I need to know that she's got an $800 benefit if I know she's getting 1,000? Well, what if Jane decided to file early at 62? The 800's reduced by 25%, but that extra $200, that spousal add-on, is reduced by 30%. If she delayed her benefit to 70, the 800 would grow by 8% a year, but not that 200. Her benefit can never be more than half of John's full retirement age benefit amount. A lot of people think, geez, if John waits to 70 and his benefit's 3,000, then she'll get half of the 3,000. No, she'll never get more than half of his age 66 benefit amount. If Jane's benefit was zero, she never had earned income, didn't work, she'd still be entitled to half of John's benefit amount, okay, just because she's married. So again, Social Security will not tell you about that extra $200 that you're entitled to. She can't get it until John collects, but that's one of the benefits I see that's missed most often.
Ash, I know one of the comments you made about the wonderful people that work at the Social Security offices is that they are not allowed to give advice. So when people show up to apply or fill out forms, et cetera, you just have to go in armed with what you know, and hopefully they have someone who can give them the information as you're providing today, because there is really no one on the Social Security side to help them navigate these things.
Correct. Yes, absolutely. And the scary part is, you know, I joke about it, but I say, if you want 3 different answers to the same question, call them 3 times, okay? Because they don't know their own rules. Honest, I mean, you do get good people. I wouldn't dismiss that. But my point is, I've had clients go in, I've done a plan for them. I said, okay, here's what you're eligible to do. They go in to apply and the person says, oh, no, you can't do that anymore. They changed the rules. And they're wrong. So what you would have to do is escalate it to a supervisor, have a supervisor review it, because otherwise you'll think they're right because they work at Social Security. But I see them mess up all the time. You
need an advocate everywhere, don't you?
Yeah.
So let's throw up our next survey question, Brittany, if you'd be so kind. And it's really just a question on, when do you and the audience plan on collecting Social Security? Are you already collecting after full retirement age, at full retirement age, or before full retirement age? Okay, Brittany, do you want to share the results for everybody? We actually have nobody who is currently collecting, so everybody is here to learn and figure out when the best time for them to collect is. So even though we don't have anybody who's already collecting, Ash, let's assume that we are collecting and that we made some sort of error. What are our options to sort of undo what we may have already started?
Social Security is fairly unforgiving, but here are 2 exit strategies. You have up to 12 months. If you filed, you have up to 12 months to pay them back what they paid you, and they'll give you 1 do-over. But after 12 months, you can't change it. The other thing you can do is, between full retirement age and 70, let's say 66 and 70, if you were collecting a Social Security benefit, let's say you retired, you're 66, and then at 68, you got a consulting gig for a year, and you say, you know what? I don't need my Social Security right now. You can suspend it. They'll stop paying you for, say, a year. And then a year later, you can turn it back on and your check amount will be 8% higher permanently. And you don't have to wait a year. You can suspend it for 6 months and get a 4% increase. So the only thing you can do otherwise is stop and start it between full retirement age and 70. You can't do any suspensions prior to full retirement age, though. So you're fairly limited. And I've had clients who heard me speak and they filed 6 months ago and they said, you know what? I'm going to hire you to do an analysis because maybe I made a mistake and the window's still open for me to undo my filing option. So it's important to know you can do that.
Right. We did touch already on spousal benefits. So I don't necessarily, we did share the slide at that point, but we are going to talk about a little bit more complex issues in just a few minutes. But regarding spousal benefits, do they apply to same-sex couples?
Yes, absolutely. Since same-sex couples marriages were legalized, they're now eligible for all the same filing benefits as heterosexual couples. So I probably get a new same-sex couple client every month because it's the first time they've had an opportunity to look at spousal benefits, survivor benefits, children's benefits, child and care benefits, so many of the other benefits that they were not eligible for before. So it's very important because it's such a critical pension benefit that, you know, that they look at it now, they get their statements and they look at what their options are that they dismissed up till then.
Right, right. So you refer to something called maximum strategy versus the sweet spot. Can you explain to us what that means in a little bit more detail?
Yeah, this was an eye-opener for me. When I first started doing plans, I assumed my clients wanted me to find them the most amount of money they could get, which makes sense, right? And I still do that. I'll say, look, of all those 500 plus possible filing scenarios, here's the one that will pay you the most amount of combined lifetime benefits. And I would say over 90% of the time, my clients do not choose the strategy that pays the most. And they shouldn't, because it's not just about how much you get, it's when you get it. So for example, let's say I show you a strategy and in 25 years from now, you'll get $80,000 more than another strategy that would pay you more now, but less later. Is the 80,000 more really worth it? Like, what if you don't live 25 years? What's the net present value of that 80,000? What if you could secure an extra $100,000 in benefits up front? You know, when we do retirement planning at One Team Financial, we talk about retirement in 3 stages: the go-go years, the slow-go years, and the no-go years. Okay, people want their money in the go-go years because the utility of it's higher. They want to enjoy it. So it's not just about plug and chug, which pays the most. It's how do you maximize the dollars up front without leaving too much money on the table down the road. But you actually do want to leave some on the table because it allows you to secure more benefits up front. So the sweet spot that I talk about, you know, I've had 2,000 clients. I've never had a single client ever end up doing what they were planning to do. I always ask them, if I didn't exist, what were you going to do? Then I do their plan and they're like, oh, well, now that I see that, I'm going to do something different. Because once you see side-by-side cash flow comparisons, you'll see just how much more money you can secure up front, but you don't want to leave hundreds of thousands on the table down the road. So you have to actually run the scenarios and find that. But I think every couple has the perfect filing strategy for them. There's no cookie cutter answer. Should you take it early? Should you delay? It's really an individual strategy because everybody's situation is different. What other assets do they have? How long do they plan to work? What's their health status? You know, do they have former marriages? Do they have minor children because it's second marriage? You know, do they have other pensions? You really have to, as a financial planner, I look at Social Security as part of your overall retirement plan and say, how does it fit in best for you in your particular situation?
Great segue into the next topic, which is a little bit more complex when we talk about marriages and divorce. And I know you have great client stories to share during this segment. And certainly a lot of what we're going to talk about pertains to many's on the call situation. So we're going to throw up our survey question. This is another fun true or false. So if you are divorced, true or false, your ex-spouse may be able to collect Social Security benefits under you. What do you guys think? Of course, we're going to get the real answer from Ash, but I'm curious what those on the call think. All right, Brittany, you want to share what our results are? Okay, Ash. Yep. Second, third, fourth marriages, all very common. I know you have really interesting statistics about the divorce rate as we go into second, third marriages. We've got different children being born from all these different marriages. How do spousal benefits play into this maze of Social Security with all these multiple marriages?
Yes, absolutely. Yes, as you can imagine, the number of different marital situations across the country are quite varied. All right. So when it comes to divorce benefits, I have to tell you, I was shocked that Social Security would allow you to collect benefits off a former spouse. And they literally pay out tens of billions of dollars in divorce benefits because the divorce rate's so high, right? I mean, the divorce rate on first marriages is around 50%. But surprisingly, the divorce rate on second marriages is 68% and third marriage is 74%. There's no learning curve here. The divorce rate just keeps climbing. And so people want to know, can I collect off my former spouse? What if my former spouse remarried? Can I collect off my former spouse? So this is one of the most complicated areas in Social Security planning, but there are some basic criteria that you need to meet. Your marriage had to have lasted at least 10 years. You know, I have a client married 9 years and 2 months. He just emailed me, said, we were going to get divorced next month. Should I wait to 10 years? Yeah, I think so. So here's the thing. You had to be married at least 10 years. You and your ex-spouse have to be 62 or older. You have to not have remarried, okay? And you have to be divorced for at least 2 years. Unless your former spouse is already collecting, then you don't have to wait the 2 years. So those basic rules, but there are so many exceptions to the rules. But this ties into the other spousal benefit rules. So basically the rule is this: if you met all those criteria, you could be eligible to collect a benefit equal to 50% of your former spouse's benefit while you defer your own. But again, for that to happen, you had to be 62 or older as of January 1st, 2016. On the other hand, if your own benefit's less than half of your ex-spouse's benefit, you're eligible to collect the higher of your own or half of their benefit amount. Okay, so that's just on the spousal benefit side. It's also important to know what the survivor benefit rules are. Okay, so I got an email from, I guess, one of your clients who said, I'm 63, I got remarried. Can I collect off my former spouse? Well, if you're remarried, you can't collect off a former spouse unless your current marriage ends, whether it's through divorce or death. So since she remarried, she can't collect an ex-spousal benefit, but she's still eligible to collect an ex-spousal survivor benefit, because if you remarry after age 60, you can still collect the survivor benefit off your former spouse, even though you got remarried. You get remarried at age 59, you can't do it. So again, the timing of when you remarry is also important. There's just so many crazy scenarios. I've had clients who are married like 3 times, right? One of my clients, he's 62, his third wife, former wife, was 35. And they had a 6-year-old child together. Now, when he files at 62, that child can collect 50% of his full benefit until the child's 18. That's over a $230,000 child benefit. And the ex-wife can't collect anything, but if he predeceased her, if he got hit by a bus at 62, he died, then the child will get 75% of his full benefit until he's 18. And now she can collect 75% of his full benefit for a child in care survivor benefit until the child's 16. That's another almost 200 grand. So my point is that mixes up child benefits, ex-spousal benefits, survivor benefits. I mean, there's so many layers to this. So every scenario is different. When I ask, I get a new client, they tell me they were married before. I said, is your former spouse alive? Some of them don't even know. So I'm like, we need to find that out. Because if he's dead, this is a good day. No,
they may ask you how much it's worth to find that out.
Yeah, right.
Wow. So that is a lot to unpack. And that's why you may start to figure out, audience, why we said if you have a very specific situation to your life circumstances, we couldn't possibly cover all those different iterations, but we do want to touch on a lot of the different topics and areas where you can collect benefits, so it does resonate with you or someone that would need to dig a little bit deeper into your own circumstance. So Ash, since anything more that you want to say about survivor benefits or benefits for children when we do have these mixed marriages?
Let's just start with the basic survivor benefit. You can collect a survivor benefit as early as age 60. If you're disabled, you can collect as early as age 50. According to Social Security, they give the wrong survivor benefit advice out 83% of the time, which means it's higher. Okay. In other words, they're always wrong. Okay. But if you're past age 70, right? The rule for survivor benefits is the surviving spouse gets the higher of the 2 checks, but not both. So if your spouse predeceases you and their check's higher, you switch from your check to their check. If your check's higher, you just keep collecting your check. Where it gets complicated is if death occurs prior to age 70. So let's say, both spouses are 65 and one spouse passed away. The spouse that passed away, if they have a higher benefit, you would think, all right, well, the surviving spouse should switch from their benefit to that higher survivor benefit. But because the surviving spouse hasn't reached their full retirement age yet, they're not 66 or older, they're better off taking their own reduced benefit first, and then at their full retirement age, they're eligible to collect 100% of the survivor benefit. So again, you don't want to lock yourself into a lower survivor benefit by filing prior to your full retirement age. So it's not the age of the deceased spouse that matters. It's the age of the surviving spouse that determines how much you get. Okay. So you could collect survivor, defer your own benefit to 70, and then switch to your own higher benefits. So you got to look at all your filing options that you're available to. But because a second marriage is often, the parents are in their 60s, but they have minor children, maybe they're 10 years old. So if one spouse passed away, that surviving child is eligible for 75% of the full benefit amount of that spouse, the parent that passed away. So again, and if the surviving spouse is not working and is taking care of the child, that surviving spouse could get a child in care benefit until the child's 16. So, I mean, I see people miss these benefits all the time. But even if death doesn't occur, let's say I have a client, he's 67 and he's got a 14-year-old child. He's got to pay for that kid's college, right? So maybe it makes sense for that father to file for benefits at 67 because that child's going to be eligible for an amount equal to 50% of what he would have gotten at his full retirement age, in addition to the father getting his check. And if his wife was not working, didn't have earned income, she could also get 50% of his benefit until the child's 16. So you could literally trigger 3 checks. And if death occurred for the parent, then it would be even higher. And if one parent files, but then 2 years later, the other parent files and their benefit's higher, the child's going to get a bump up in their benefit amount. So yeah, it gets complicated, but there's a lot of money in the system and you don't want to leave it on the table.
Definitely not. Definitely not. Very eye-opening. And so when we talk about going to actually file, do we as the person collecting Social Security basically need to tell Social Security all of this information because they're not going to give us the right mix of 50% of my spouse or the higher of what I have? I mean, how much legwork is there as an individual to have to essentially educate the Social Security office of what it is that you want to have?
Yeah. I mean, if they were a client of mine and I basically laid out, here's your filing strategy, here's what you need to do, go to Social Security and tell them, here's what you want to do. Now, you're only going to go to them when you're ready to file. Like if my plan says next June, you're going to file, usually a couple of months before, you're going to either call Social Security to schedule an appointment to do it. Because of COVID, all the offices are closed. So you do it either over the phone or you could go online and file. But let's say you started collecting a spousal benefit at 66, and then your plan was at 70 to switch to your own because it's higher. Social Security doesn't automatically switch you from your spousal to your own. You still have to, you've technically not filed for your own benefit. You're collecting a spousal. So when you turn 70, you've got to actually go back and say, stop paying me my spousal. I want to start collecting my own now. Because they'll just keep paying you your spousal. And then you're 75 realizing, wait a minute, I just missed 5 years of my own check amount and you can't go back. And here's an important thing to know. If you've missed benefits, the most they'll go back is 6 months. Okay. And in fact, prior to full retirement age, they won't go back at all. So if you're 68 and you think, geez, I should have filed at 66, you can't go back to 66. You can only go back 6 months or less, right? Full retirement age is 6 months. But if you're 64 and say, geez, I wish I filed at 62, you can't go back 1 month. So it can be difficult to fix things if you've missed it, which is why we encourage clients to do planning ahead of time, because you don't want to find out later. Like a lot of people say to me, when I get close to retirement, I'll call you. And I said, no, call me and I'll tell you when you can retire, because you don't want to find out later that you've missed all these opportunities.
Well, and that's a valid point, Ash. And so when is a good time to really start the planning process? I mean, is there a certain age that you recommend? Is it if there's a life change, like a death, a divorce, or a marriage? When really would you advise?
Yeah, I would say most
get a plan
of my
on paper
clients
for this.
are late 50s to 70. Okay. Because if there's a death, the survivor benefits can be triggered as early as 60. So you want to know that. But if it's just regular retirement planning, some people, as you know, Sarah, some people are real planners. They want to not go into retirement. They want to try to figure out where they're going. They want to say, well, what are my projected benefits going to look like? What's the smartest way for me to plan for Social Security and integrate it into my overall planning? So I'm seeing more and more clients in their late 50s who are coming to me to get, eyes open. What are my benefits? But a lot of times, they're already in their early 60s, mid 60s, even late 60s. I have a client who's 3 months from turning 70 and said, well, there's nothing for me to do. I'm just going to wait 3 months. I'm like, actually, when I did his plan, I said, no, we're going to backdate 6 months. Right. You should have called me 4 years ago, but whatever. Even waiting 3 months would be a mistake. Right. So ideally, late 50s, early 60s, but anytime really between late 50s and 70.
And would you recommend, if there's an age difference in the spouses, that first spouse to hit that 50, 60 mark is when you start the plan?
Yes. If I have a 65-year-old, say, husband and a 55-year-old spouse, it's really going to be based on the 65-year-old, because as soon as one of them becomes eligible, right, 62 or older, that's when you should start looking, because the optimal time to file for the older spouse will affect when the younger spouse should file.
Right. So many of our clients are business owners, self-employed. Can you give us some best strategies to help them consider what to do when it comes to taking Social Security and how that impacts their earnings from a business and things of that nature?
Absolutely. Yeah. Business owners have more options than W-2 earners because they can do things with their income. They can move income around. So maybe I'll give you an example that may help illustrate it. So my client who's 68, he's a business owner, very successful. He makes $300,000 a year. And his wife is in the business with him, is 65. She makes $100,000. So combined, they're making $400, but for whatever reason, he's getting $300, she's getting $100. But he's 68. He can actually file for Social Security regardless of his earnings. He's past full retirement age. His 65-year-old spouse can't because she hasn't reached full retirement age yet and her income's too high. So he's thinking, wow, if I can file now, why don't I just file and start getting my checks? And I said, well, we can look at that. I mean, there's a lot of scenarios we're going to look at. But one of the things I'm going to do is think about reallocating earnings. Why not stop paying your spouse the $100,000, pay you $400 and pay her nothing? Well, why would we do that? Well, we just saved $12,400 a year in Social Security taxes, right? Because they pay 6.2% as an employee and an employer. But what else can we do? Well, now she has no earned income. So she can file early. So she takes a reduced benefit at 65. And now he can collect 50% of her full benefit as a spousal benefit while he defers his to 70. So what did we do? We saved $12,400 a year in Social Security taxes and started 2 new Social Security checks. There is no software that does that. Don't even think about going to Social Security with that one. My point is income planning and repositioning income. The other benefit, the question I get is we're late 50s. And for years, I've been keeping my spouse's benefit very low and mine high to save on the taxes. Was that a smart thing to do? What if I reallocated some of my income to her and increase her Social Security check? Is it worth doing that? So I run the analysis on that as well, because if she's not if he wasn't paying her a lot of income, her Social Security benefit is low, right? Is it worth the investment to reposition some of his income to her in that particular scenario? So again, you got to run. I get business owners have to do proactive planning because their mindset's always been keep taxes low, taxes low, taxes low. But you can really hurt your Social Security benefit by doing that. So you have to figure out, well, what's your optimal income allocation to maximize Social Security benefits?
Do you have a different age for planning for people to come in if they're business owners with you? Is that age lower because there is more flexibility with the income?
Yeah, I see a lot of business owners in their early 50s come to me because they're saying, you know what, we hope to retire in 10, 15 years. Here's a Social Security statement. Sometimes one spouse hasn't even earned a benefit, right? Because they've been off the books and they've got like 8 years of earnings. So 2 more years of earned income at $1,470 a quarter, which is nothing, right? She can earn a $500,000 pension. So, and when I say business owners, these are doctors, right? Doctors, dentists, other professionals where maybe the spouse is in that practice with them. And they haven't done proactive planning with respect to Social Security, just with taxes and, funding their retirement accounts.
Right. Good to know. So throughout the presentation, you did touch on various situations where children could be eligible for benefits. Can we sort of just do a quick overview of ages and situations of when kids really would be eligible? Because I know you said that is one of the areas that is largely overlooked by people as far as benefit checks go.
Yeah, you would not normally think there'd be child benefits involved with Social Security because the parents are in their 60s and have grown children, but because of second marriages, they often have minor children. So if a parent files for Social Security, which they could do as early as 62, if that child is a minor child, they can collect a benefit equal to 50% of that parent's full benefit amount until the child's 18 or 19 if they're still in high school, okay? Because it depends how old they are. They'll keep paying them until 19 if they're still in high school. And it's a very rich benefit. If a parent passed away, then that child's eligible for 75% of the parent's full benefit until they're 18 or 19. Still not. If you have multiple children, they're all eligible, but there is a family maximum. You know, Social Security, if you have 8 kids, they're not all getting half, right? So there's a family maximum, but the point is, once a parent files or passes away, that child's eligible for that benefit amount. And if the surviving spouse doesn't have earned income, they can collect child in care benefits. That one gets missed a lot until the child's 16. So, it's really important to understand. Now, this could go on and on, right? What if the child was disabled? The disabled child can also be eligible to collect benefits past age 18 and 19 if they stay disabled as disabled child benefits. So, what about children from former marriages, right? If it's an illegally adopted child or a child from a former marriage, they're eligible for child benefits, even though you're divorced from the mother. So, there's a lot of different scenarios.
And it always amazes me that at the front end of collecting and being eligible, they don't tell you anything. But I can assure you that when my grandmother passed, they knew almost to the day when she died and wanted a clawback of those benefits that she got that was, paid past her date of death. So they're looking, just not on the front end.
No, not on the planning side. Yeah.
So you did touch a little bit on strategies for Social Security around college planning. But I know you said in our planning session for this that there's college planning benefits as well as estate planning benefits related to the Social Security strategies, which many people don't think of at all. So could you give a couple of examples of why that plays into the Social Security planning?
Sure, absolutely. So the college planning, Social Security doesn't pay for college benefits per se. But again, because of the scenarios with second marriages, with parents having minor children, because this child benefit is so significant, right? Let's say a father is 66 and they have a child who's 14, but they have a spouse who's 10 years younger. Okay, so the wife is 56. Complicated scenario here because yes, the father can file at 66, collect, say, his $3,000 a month benefit. The child can collect a $1,500 a month benefit. That's $4,500 a month, right? That you can sock away into a 529 plan for 4 years. But if you start at 66, you've also reduced the survivor benefit for your spouse who's 10 years younger, a woman who's going to outlive you by 15 years, right? So is it better to take the child benefit and your own benefit early and reduce the survivor benefit for your younger spouse? You got to look at that. What if the child was 16 and you're 66? You could file at 66. The child can collect 2 years of child benefits. Then you could suspend your benefit at 68. It'll grow again by 8% a year till age 70, and then you can turn it back on, right? So you've got to look at what all your options are and how it plays into your overall situation. How important is the survivor benefit? Do you own life insurance or not? Because if you do, then deferring to 70 may not be important. When it comes to estate tax planning, when the Wall Street Journal interviewed me for an article, they said, well, what should high net worth people do about Social Security? And I can tell you, Sarah, here's what they do. First of all, they're not even looking at it, right? They're like, I don't need Social Security. Most of their advisors are saying, don't take it. You're just going to pay income tax on it. Defer to 70, max it out, then take it. Like you have to, right? Just take it. Warren Buffett collects Social Security. So they want their money, but they're in no hurry to pay taxes. So they're like, I'll just delay it. And I told the Wall Street Journal, you know what? I would do the exact opposite. I tell my high net worth clients, take it as soon as you can. And you think, really? Why would you do that? So I'll give you an example. Real case. My client's worth $80 million. Why in the world does he need Social Security? He doesn't need it, but he wants it. He's thinking, I'll just defer to 70 and max it out. And I said, no. You and your spouse, in their case, they were 66. I said, I want you both to file like now. Take your reduced check at 66 instead of deferring to 70. Combined, they would get about $50,000 a year. Okay. I said, take the $50,000, pay the income tax on it. That nets you 35. Gift the 35 into an irrevocable insurance trust. It'll buy about $2.5 million of life insurance. So basically, we turn the Social Security income stream into 100% income and an estate tax-free asset with life insurance in a trust to pay as estate taxes. Because when you're worth $80 million, your biggest concern is not income, it's estate planning. All right. I have a surgeon client in New York who said, I want to leave my grandchildren $2 million. I said, great, let's get Social Security to pay for it. I said, what do you mean? I said, you and your wife start collecting your Social Security. We're going to gift the net after-tax amount into a trust. It'll fund a $2 million life insurance policy in a trust for the benefit of your grandchildren. Because when you and your spouse pass away, there is no money for the kids or grandkids, no survivor benefits for children or grandchildren. But now we're using this income stream from Social Security to create a 100% tax-free asset and a legacy asset for your children and grandchildren. So, I mean, I'm glad I came to Social Security from the financial planning world because I see it as just another asset in retirement. How does it fit into your particular situation best? And by the way, you don't have to be worth $80 million. You know, Gina and I have a client who is divorced and has a granddaughter that she wants to make sure is taken care of. She was going to set aside money for the granddaughter, but she doesn't need the Social Security income for retirement. She has a healthy pension and other assets. I said, look, let's use a portion of your Social Security to fund a $500,000 life insurance policy and trust for your grandchild. And so now only a small monthly payment is going to create guaranteed $500,000 for that grandchild. She doesn't have to give up any of her own assets to fund this trust. So again, it's financial planning on the global sense, but you want to drill down and see how does Social Security fit in best for that person.
Right. It is a complex, meaty subject that, you know, the question of do I collect early or do I collect later is just the tip of the iceberg on all things Social Security. I do want to touch briefly on taxability, and you talked about it with your high net worth individuals and how other financial planners advise with Social Security. Just a brief overview of the taxability of Social Security and its interplay with other income in retirement.
Yeah, great question. Okay. Social Security is actually a tax-favored income stream. They calculate something called provisional income, which is your adjusted gross income plus half your Social Security plus any muni bond interest. If you add that all up and say you're married filing jointly, if your provisional income is over $44,000, you will have to include 85% of your Social Security income as ordinary income for taxes, for federal taxes. So 15% is exempt, 85% is included in your taxable income. Just to be clear, that's not an 85% tax. Some people get confused. If Social Security paid you $10,000, you have to pay income tax on $8,500 of it. But it's exempt from state income tax, even in New Jersey, which means everywhere, right? So so if you took a distribution from a traditional IRA, you would pay income tax on 100% of it, federal and state, but not Social Security. So right now, it's still tax favored. But again, if I'm in an extreme case, if all your money was in a Roth IRA and you took distributions and you didn't pay any income tax, you don't have to pay any income tax on Social Security, right? Because as a married filing jointly, if your combined incomes or provisional incomes under $32,000, it's tax exempt. So when some people think Social Security is tax free, some people think it's fully taxable. All right, it really depends on what your provisional income is, which determines the taxability of it. But it is definitely tax favored. You don't have to move to Florida to get a state tax exemption on Social Security.
But that is important to note that there is an interplay on the federal side, at least, with, you know, potential earned income that you're going to have in retirement, so that people can work that into their plan as they decide when they're going to file or not from a cash flow standpoint. So I do want to, as we wrap up to the top of the hour, there are a couple of questions that did come in pre-registration. Again, if it is a customizable question to your specific situation, Ash has been gracious enough to offer a 15-minute consult, which we'll cover in a few seconds. But Ash, one of the questions that came in was, how do you work with other advisors in this space?
Yeah. So what I find is there are a lot of outstanding financial advisors out in the marketplace, but they may not have an expertise in Social Security plan. And I think to help them do the best job for their clients, what I do is they can, or their clients can engage me just to do a Social Security analysis for them. I don't do any other work with that client. I won't do the investment insurance, other work I might do with our own clients. But if they want to engage us, and sometimes I've had other advisors pay the fee for their client because they're saying, look, I want you to figure out their best Social Security filing strategy. So I want to make sure they get it right. They will take the cash flows that I generate and integrate it into the overall retirement income plan for that client. So I become a resource to that financial advisor. So I would say the more enlightened financial advisors I run into won't find me threatening. They'll say, no, I want to leverage your expertise. We're all professionals. So I think that I'm open to working with other advisors in that respect. Yes.
Good. I like that mindset of abundance and working together for the betterment and what's best for the client. That's good to hear. So we will wrap up. If you have any questions, please put them into the chat. I do want to give you, Ash, an opportunity for any final thoughts on this topic that you might want to share with the group.
Yes, I would say in my experience, traveling the country, speaking to lots of different groups, that the importance of Social Security has just grown even more and more and more. Many people are really just not prepared for retirement, and they've really never looked at Social Security. They used to get a statement, look at it and say, geez, I hope it's there when I retire, and throw it in the garbage, right? They don't realize that it's $1 million plus pension, a very rich pension, but it is so complicated. It's not as simple as when I stop work, I go get my Social Security, or if I wait, I get more. You're almost certain to leave money on the table doing that and not find your best strategy. So you literally want to be proactive as possible, put together a plan, understand how all the rules and regs work so that you can optimize your benefit, and take advantage of this federally guaranteed lifetime pension. It's not going away. And for many people, for 40% of the country, I have to say 40% of the country, Social Security is their only income in retirement. Okay, so it's very, very, very important. So if you've never looked at it, whether you have you're a high net worth person or not, everybody has a unique, optimal filing strategy for them. They all have that perfect sweet spot strategy. And I think it's worth an investment to have a customized plan done, get it right going in. I say, why would you took you 35 years to get this benefit. Why would you drop the ball on the 2-yard line? Now's your time to get it right.
Absolutely. Absolutely. It is very much worth the investment in doing the research and teaming up with somebody to get the knowledge. And we may have only scratched the surface on this, but I know that you will make yourself available for a deeper dive on individual plans for our audience members. So thank you, audience, for joining us. Ash, again, thank you so much. Please let us know if anybody has any ideas for future topics for office hours that you want to hear about. Have a great rest of the day and a wonderful weekend. Thanks, everybody.
Thank you all. Thanks.